I think, first of all, like, you can't just listen to one meeting. I think you need to kind of hear his language over time. So you start to kind of get an idea of the words that he uses and also the direction. So a lot of times we look at charts because it's not just the data point necessarily, but the direction we're going. And he said as much. So for example, they talk about getting inflation back down to 2%, which is their not written and mandated goal. It's just that's sort of their goal. And he talks about that often. We need to see more data, not one data point, but multiple data points that we're going in the right direction. So for example, he threw out in the presser that inflation has decreased from a peak of 7% to 2.5%. So one, we're almost at their hopeful target, which I thought they were ready to abandon, but the direction that we're going from 7 to 2% is massive. So we're pretty much there. But he also said that it's not just one data point, but a multiple of data points. And so specifically, he mentioned the labor markets. And really, I think that's one of the markets that I keep my eye on the most because that's the one the Fed cannot allow to get away from us. Unemployment is a lagging indicator. Employers will hang on to their employees to the very last minute. They're going to cut even their own pay before usually they'll start to let go of people. So usually when we see the unemployment number spiking, it's already too late. And then those are sort of asymmetric, meaning those losses are very hard to get back. So that's something I think they're really watching. And unemployment remains low, they say, at 4.1%. However, that's up. So, right, it's moving in the wrong direction, but while inflation is moving back down. So, he says he wants to be data dependent. I think the shift in his language, there's a couple things in there, though. So one, he said, so we're not ready yet. It's probably on the books. We'll look at it again. So he's already basically planting the fact that there will be a rate cut in there. Number two, he talked about, not moving too soon. There's a problem with that. But if you listen back to his interview that he gave with 60 Minutes a few months ago, and other interviews as well, he said that there's more risk in moving too late than there is too soon. That's what he said in the 60 Minutes interview. Another time he said, we'd rather break things because we have the tools to fix them. And so those basically tell us that they're sort of do whatever it takes to kind of keep this going. And then we can just look at where there's real skin in the game, and that is the CME Market Watch, which is sort of the betting markets, if you will, of what the Fed is expected to do. And that's at about 100% chance we'll see a rate cut in September. I think there's really a big divide that a lot of people aren't really picking up on, are that there's a big difference between the economy, recession, and the markets or asset prices. Sure. And so when we think about, are they too late? Well, too late for what? So for example, we know that banks' losses are at all-time highs, over $500 billion of what we call unrealized losses, paper losses. Should they have cut back to help that? Maybe loans aren't happening. The money expansion isn't happening as fast because loans aren't being produced as fast because rates are high. So we can look at it from that perspective. However, asset prices are maintaining their highs. As a matter of fact, we're seeing stocks breaking out based off of this news announcement already. S&P 500 and NASDAQ are near all-time highs, as is Bitcoin, et cetera. So it depends on who you are and what data point you're looking for. I would love to pile on for the Fed. I'm easy. I love to jump on and tell them that they're idiots. But so far, nothing has broken. Now, the problem is probably by the time they get around to it, maybe things are too late. But that just means that the size and speed of their move will just be bigger. Well, just going back to the difference between the markets and the economy for a second, and back to the economy, and you mentioned a lot of people are struggling. Obviously, we know that inflation has inflated the CPI, consumer price inflation. The cost of gas, the cost of food, cost of travel has gone up by a lot, homes, et cetera. And so it is harder for people to live. But what we're really seeing is this divide in the economy specifically. And we can see that the upper end of the economy, I live in Southern California. It's like all, multi-million dollar homes, $5, $10, $20 million homes here. Those are going up like crazy. One of my builder friends the other day, he works on, $20 million plus homes. He said, oh, this person bought this home and they're gutting it out. I don't know how much the remodel is going to be. I'm like, $3-4 million. He's like, oh, no. I just do the wood. My wood bid was $3 million. Wow. So at that level, right, as we see, the reports from Gucci and Louis Vuitton, like those numbers are still moving up. I'm also building a house down in Mexico right now, and the $20 million homes are as far as the eye can see, and they're busier than they've ever been. So what we're seeing is this bifurcation in the economy where unfortunately the lower end people are really suffering from inflation. But on the upper end, as I said, the asset prices are at all-time highs. That part of the economy is still really booming. I have been openly calling for higher inflation. I'm an inflation bull. I believe the rest of this decade is extremely inflationary. They can hide it in CPI, but I look back to the original definition of inflation, which is the expansion of the monetary supply, the monetary base. What we can see is that over about the last decade, the monetary base has been about 8%. However, since about 2019, it's been about 10%. So you take the monetary debasement plus the rate of inflation, 3 to 4%, et cetera, we're really at about 12%. That's the hurdle rate as an investor that we need to beat. That's why, even though you see, your S&P 500 going up, you're not getting more rich, right? You can't buy more goods and services. And so that's sort of the outlook. I'm an inflation bull. We have the world breaking apart. The BRICS nations are challenging. Supply chains are breaking down. And now the U.S. is in this sort of nearshoring sort of move, which means prices are going up. We can look at them across the board. We can see that there's lots of calls to print more money. The G7 now wants to spend about $10 trillion to sort of rearm the military. Janet Yellen wants to spend $78 trillion to sort of transition this green economy. And so it's going to be continuing to see more and more inflation. That's the macro outlook. We can look at lots of indicators. Specifically, one of my good buddies loves to talk about the yield curve control and how that spells out a recession. But in my opinion, and you've heard this many times, and I just agree with them, that the Fed between the rock and the hard place, so to speak, there's no way out but inflation. And so if we were to have a recession, that just means more inflation. I made a video talking about how the Fed cannot, or the government cannot afford a recession. So typically when we see a recession, we see tax receipts drop by somewhere between 12 to 15%. They can't afford that. They're already running $2.5 trillion deficits. How do they afford that? And so really we're in the situation where all roads lead to more government printing and more inflation. And so while everybody is predicting this big crash, I've been sort of on the opposite side for about a year making videos saying that there's just no crash coming. I believe Harry Dent Jr. on your show several times. I've had him speak at my conferences. I've read like 5 of his books. His research is amazing. I think he's absolutely right with his research. However, his conclusions is he's been calling for a 90% crash for 12 years now. It's never come. So when I say crash, there's certainly different ways we can look at that. I guess specifically I'm talking about asset prices collapsing, right? So everybody's expecting for the next housing crisis to come. Everybody's expecting for, the banks to collapse. Everyone's worried if their money in the bank is safe. What will happen with their retirement portfolios. So when I talk about crash, I'm more specifically talking about a big deflationary event in asset prices. Now, as I said, the economy itself is bifurcating. And so the recession will continue. I would imagine that we'll continue to see GDP growth continue to grind slower and sort of go into this stagflationary period. And that's not good. Right? It's not good. So we'd see GDP grow slow, the economy would slow down. That just forces the government to, again, produce more stimulus because tax receipts have fallen down. Plus, they need to support those people. So I don't see a big crash coming in asset prices. I do see problems in the economy, specifically in businesses that are sort of dependent on that recessionary boom. That I look at the market, there's a few people that I talk to pretty regularly, Luke Grauman being one of them, Raoul Paul being one of them, that we just sort of look at the market a little bit differently. And I believe, like they do as well, that the market really changed in 2008. And so when you're looking back to the 70s, the 2000 crash, the 70s crash, the 50s, the 40s, all these different analogs, they're certainly helpful for sure. But what happened is something changed in 2008 in the way that not just the Fed, but all central banks work in the economy. And so really what happened in 2008 is the entire world sort of reset, right? If your bank says, hey, we'll lower your rates to 0, you're going to refinance. And that's exactly what happened in 2008. So the whole world refinanced to 0. Now we know, most people know, that in a debt-based monetary system, that it has to continually expand. The debt never gets paid. The debt gets rolled. And so we need more debt to pay off the old debt. President Biden told us as much when they were having the last debt ceiling debate. He said, hey, the U.S. has never defaulted. We need to get more debt so we can pay off the old debt. Like literally, that's what he said. And so the debt continues to grow. We got it reset in 2008. That was the first time that we saw in the United States this massive quantitative easing. The balance sheet shot through the roof. But more importantly, what happened is these too big to fail agencies got bailed out, but they only got bigger. And we're in a situation now, as I kind of already said, that the government cannot afford a recession. We cannot afford to see prices drop. Part of the reason why is back to the debt-based monetary system. In a debt-based monetary system, money is created through debt issuance. So that means the dollar is a liability and the debt is the asset. And the debt being the asset then becomes collateral for more debt. And the problem is that if these asset prices start to fall down, then there's not enough collateral for the other debt that's out there. And that will cause a massive downward spiral that we could not handle. Now, in my experience, and from what I can see in the world, in current day times right now, if we look at Lebanon, Turkey, Venezuela, Argentina, et cetera, right now today Zimbabwe, or we look back through history, there's never been any time ever that a government said, well, pack it up, boys. It was a good run while we had it. Let's just let it all crash down. No, they will always continue to print as long as there's ink in the printer. We see it every day. And so I think we can see that it's fundamentally changed. We can see that the system's been so levered up. We can see that there is just no way to have more than about a 20% drawdown in these asset prices without having the whole thing collapse. We can see the way that they changed just from 2008 through 2019. And I believe it will only be faster. They're going to continue to prop these things up and push these assets sky high. So let me just give you an example. So for example, what do you think the biggest asset bubble is? Do you think it's real estate? Do you think it's stocks? Do you think it's Bitcoin or other? And it's about a 50-50 tie on a couple thousand votes on real estate and stocks being in a bubble, asset bubble. There's no shortage of people across Twitter that I've had to kind of go back and forth with calling that homes are in an asset bubble. Homes are going to come crashing down. Okay, well, let's just take a look at this, right? We're looking at all-time highs in houses, surpassing the 2007-8 high. We're seeing all-time highs in stocks, as I said, right? Back to all-time highs in Bitcoin. But we're looking at the underlying denominator, the US dollars. You said it was manipulated. We're looking at a manipulated denominator. And so while we're looking at the top line number, thinking it's in a bubble, we're not realizing the bubble is actually in the denominator in dollars. So what do I mean by that? I had to kind of set somebody straight and post the actual chart, not opinion, but data. And if you look at the US median real estate price, Case-Shiller index for national Case-Shiller index, divided by the M2 money supply, you can see that we are nowhere near a bubble. Now you can see that the homes did get overextended back in that 2007-2008 bubble above the money supply, but today they're only keeping up with. They're a perfect proxy for inflation. Back to equities as well. If we look at the global liquidity numbers, or even just look at the Fed balance sheet, you can see that the S&P 500 to global liquidity is about a 90, almost 95% correlated. And so that means that the S&P 500 is moving up almost exactly at the same rate as the money supply. So it's not that stocks are in a bubble or homes are in a bubble, it's the dollars that are in a bubble. Now, of course, Bitcoin moves up much faster. That's a different subject. But yes, we're looking at a manipulated denominator, the dollars, and it's about purchasing power. So if we look at things in terms of purchasing power, instead of homes priced in dollars, how many barrels of oil? How many pounds of oranges? How many tons of rice? And how many Bitcoin? I have been on a Bitcoin standard for a number of years now. And for me, while the whole world sees prices getting more expensive, I see things getting cheaper because I'm not using the manipulated denominator, because I'm pricing things in Bitcoin. But you could also price things in oil or gold or oranges or rice and see sort of the same thing.